As the market continues to churn, NUBURU Inc., trading under the ticker BURU on the NYSE American, is currently priced at $0.29, marking a significant intraday drop of 13.36%. The stock opened at $0.31, briefly touched a high of $0.32, but has since fallen to its current level, which also marks the low of the day. Now, seeing a drop like this on a low-priced stock might immediately trigger thoughts of failure, a company on its last legs, just another casualty in the brutal small-cap landscape. That's the surface-level expectation, but the reality of what's happening with NUBURU is far more complex and centers on a formal notice the company just received, a notice that puts its very presence on the stock exchange on a strict timeline. On October 16th, NUBURU disclosed it had received a notice of non-compliance from the NYSE American Exchange. This isn't just generic bad news, it's a specific and critical threat. The exchange has determined that the company's low share price is abnormally low, creating a situation where continued listing is deemed unadvisable. This is different from the more common non-compliance issues related to minimum bid price or market capitalization. This is the exchange essentially saying the stock has become so cheap that its utility as a publicly traded instrument is in question. This single development is the primary driver behind today's fear and selling pressure, and it fundamentally changes the calculus for anyone holding or considering this stock. Most investors looking at a chart like NUBURU's see a story of decline and assume the underlying business must be collapsing. The narrative is straightforward. A company that came public via a SPAC merger, like so many others, has failed to deliver and is now fading into obscurity. From a 52-week high of $0.99 to a low of $0.12, the trend certainly supports that pessimistic view. The common belief is that the technology, whatever it is, hasn't found a market. The management is struggling and the financial runway is shrinking to zero. This is the easy, accepted narrative. However, challenging this requires looking past the stock price and understanding the asset trapped inside this broken stock structure. NUBURU is not selling a simple commodity. It's a pioneer in high-power blue laser technology. This isn't just a different color of laser, it's a fundamental shift in material processing capabilities. Infrared lasers, the industry standard for decades, are notoriously inefficient when working with highly reflective metals like copper and aluminum. Much of the laser's energy simply bounces off. NUBURU's blue lasers, operating at a different wavelength, are absorbed far more effectively by these materials. This has massive implications for industries like electric vehicle battery manufacturing, where welding countless copper foils together is a critical and often bottlenecked process. So the tension here isn't between a good company and a bad company. It's between a potentially disruptive technology and a corporate entity that is failing to sustain its public market valuation, now facing the very real prospect of being delisted. The intraday trading action today reflects this specific fear. The sell-off isn't broad market related. It's a direct reaction to the heightened delisting risk. The company has until November 15, 2025 to resolve this, which may involve a reverse stock split to artificially increase the share price. While a reverse stock split would solve the abnormally low price issue, it does nothing to address the fundamental business challenges and often proceeds further downside as it's seen as a cosmetic fix. The trading volume, while not astronomical, is likely elevated with long-term holders finally capitulating and short sellers pressing their advantage. The market cap, now hovering at a mere $4 million, is pricing NUBURU not as a technology company, but as a shell with a high probability of failure. This brings us to the increasingly important topic of short interest. For a stock in this position, understanding the short seller perspective is not optional, it's essential. For the short thesis against NUBURU is painfully clear and, on the surface, very compelling. The company is burning through cash at an alarming rate. In its most recent quarter, it reported revenues of only around $500,000 against a net loss of several million dollars. This negative cash flow in a high interest rate environment is a death sentence for companies that cannot secure funding. Short sellers are betting on the simple and powerful idea that NUBURU will run out of cash before its technology can gain significant commercial traction. They see the NYSE non-compliance notice as the beginning of the end, a catalyst that will accelerate the company's demise by making it even harder to raise capital. Short interest data for BURU has been elevated, and the cost to borrow shares is likely rising, indicating that demand to bet against the stock is strong. You can find this data on platforms like Fintel or Ortex, which track short interest percentage of the float, days to cover, and borrow fee rates. A spike in borrow fees is a critical signal that short sellers are piling in. What's your take on the rising short interest? Smart money sniffing out weakness, or an attempt to accelerate the decline of a vulnerable company? For retail investors, it's crucial to understand how to interpret this. This isn't a coordinated attack in the dramatic sense often portrayed, but rather a logical convergence of market participants betting on a high-probability negative outcome. The actionable step here is not to fight the shorts, but to respect their thesis. You must analyze the company's balance sheet, calculate its cash runway, and determine if management has a credible plan to reach profitability or secure funding before that runway ends. Chasing a short squeeze in a company facing a delisting notice and with a dire cash situation is exceptionally risky. The shorts have the fundamentals on their side, and without a significant positive catalyst, their thesis is likely to play out. The story of NUBURU serves as a stark reminder that a great idea or a superior technology is not enough. Commercial execution and sound financial management are what ultimately separate the winners from the footnotes in business history. Let's dig deeper into what NUBURU actually does, because the technology is the only potential lifeline here. The company's core product is a blue industrial laser system. As mentioned, its key advantage lies in welding and processing copper, aluminum, and other reflective metals. The primary target market is the electric vehicle industry for battery production, where welding countless thin copper and aluminum foils together is a critical and often bottlenecked process. Blue lasers can do this faster, with fewer defects, and create stronger welds than traditional infrared lasers. This also applies to 3D printing with these metals, a process known as additive manufacturing. The potential is there. Automakers and battery manufacturers are desperately seeking ways to improve efficiency and quality. NUBURU holds a significant patent portfolio protecting its technology. The problem has been converting this technological advantage into meaningful revenue. Sales cycles in industrial manufacturing are long and complex. A major automaker isn't going to rip out its existing production lines overnight to install a new, unproven technology from a tiny company. NUBURU needs to land a major strategic partner or a cornerstone customer to validate its product at scale. Without that, it remains a promising science project with a rapidly depleting bank account. Looking at their past performance, the story since the SPAC merger in early 2023 has been one of consistent disappointment. Revenue targets had been missed and losses have widened. The stock's collapse reflects this failure to execute commercially. Management has spoken about a pipeline of potential customers and advancing discussions, but the market has lost patience. Talk is cheap, especially when your stock is trading for pennies and you're fighting to stay listed on the exchange. The company's recent filings show a critical need for cash. They will almost certainly need to raise more capital within the next few quarters. Given the current share price and the delisting notice, any equity financing would be horrifically dilutive to existing shareholders. This is a classic catch-22. They need money to survive, but raising money under these conditions will crush the stock price further, making the survival of the public entity even more precarious. So what does the future hold? There are a few possible scenarios. The most bearish and perhaps most likely is that the company fails to secure funding, cannot regain compliance with the NYSE, and is delisted. The stock would then trade on the OTC markets, or pink sheets, where liquidity is far lower and institutional interest is non-existent. This would likely be followed by an eventual bankruptcy or a sale of its patents for pennies on the dollar. A second, more neutral scenario involves a successful reverse stock split to regain compliance, followed by a highly dilutive capital raise. This would keep the company alive, buying it more time to try and land a major contract. Shareholders would suffer massive dilution, but the company would continue as a going concern, albeit with a much lower per-share value post-split. Comment below with your thoughts. Do you believe a reverse stock split is a viable solution for NUBURU, or is it just delaying the inevitable? The bull case, a long shot at this point, hinges on an imminent, game-changing announcement. This would have to be something like a multi-year supply agreement with a major automotive OEM, or a strategic investment from an industry giant. Such a development could provide the revenue, validation, and capital needed to turn the ship around. It would completely invalidate the short thesis and could lead to a dramatic repricing of the stock. This is the hope that the remaining long-term holders are clinging to. For any investor involved, the key is to watch management's actions, not just their words. The immediate focus must be on their plan to address the NYSE non-compliance. A definitive plan, likely involving a reverse stock split, should be announced soon. Following that, all eyes will be on their cash position and any announcements related to financing or new customer contracts. Monitor their quarterly reports for any improvement in revenue or, more importantly, a reduction in the cash burn rate. The expectation of a quick turnaround has been shattered. The reality is that NUBURU is in a fight for its corporate life. The fascinating core technology is at odds with the brutal financial reality. The market is currently betting that the financial reality will win. Without a powerful, tangible catalyst in the very near future, that bet is likely to be a winning one. The story of NUBURU serves as a stark reminder that a great idea or a superior technology is not enough. Commercial execution and sound financial management are what ultimately separate the winners from the footnotes in business history.